In this session, let's focus more on the mortgage-backed securities market. Now that we have got a brief understanding about the mortgages, their basic characteristics and all, we have to focus now on how the mortgage-backed securities market has actually evolved and what is the process of creating mortgage-backed securities. How does government agencies create MBS, or probably how do private entities create MBS? How are they typically traded? This is the entire dynamics that we are going to take up in this session. So just to understand the very basic evolution of the mortgage-backed securities market, the more and more the real estate market booming, there was a very increased usage or increased demand for the mortgage-backed securities market, because there is a very heavy drive from the borrowers for real estate based loans, and that itself has resulted in some level of innovation from the banks in terms of the lending process, and that is what has created the new dimension of the mortgage-backed securities market. And today that market, the new MBS market, which started somewhere flourishing from 1980s, this has traditionally outgrown the most traditional treasury market also today. So what happens in a typical MBS market? Okay, we have a banks which are typically responsible for approving and sanctioning of the loans, especially housing loans of various individuals. So they are the ones who sanction the loans for the individuals, taking the properties as the collateral. Now this entire set of housing loans are pooled by the banks and they are sold into the capital market. Probably they are sold to a third party entity or a special purpose vehicle in the form of, and this particular special purpose vehicle, it issues either, sometimes the banks themselves can do that process, or we have a special purpose vehicle which buys the loans from the banks and sells these loans into the capital market, by issuing mortgage-backed securities. So again, it could very well happen that out of all these loans, sometimes the loans with similar kind of characteristics, probably a similar maturity periods, similar risk levels. So like that, if at all there are loans with a lot of similar characteristics, they are pooled together and they are sold into the capital market in the form of mortgage-backed securities. So the investors who were purchasing these mortgage-backed securities, they were in turn funding back the capital that they are giving by purchasing the mortgage-backed securities. This capital again is coming back into the banking system, which can be used for a further lending market. Because of this concept, whatever was perceived as the illiquid market, typically until this concept of securitization and the mortgage-backed securities market has evolved, the typical mindset is the real estate loans or housing loans market is a very small illiquid market. But with the securitization or with the advent of MBS securities, this notion got transformed and came out as a very large, heavily liquid kind of a market. And also another important positive thing that needs to be looked at from the perspective of MBS market is even the bank's perspective. Earlier, the banks were thinking that the more they are able to collect the deposits, the more they can give loans. So loans and deposits used to be very heavily interlinked, and because of which even the deposits used to be very heavily dependent on economy and the spending capacities, or probably the consumption capacities, or the inflation prevalent in the economy, which was affecting the loans also in a direct manner. So whereas with the advent of MBS, the banks started looking at alternate ways of funding these loans, and even without the deposits in place, the loans can be created, because an active market is created today for mortgage backed securities. That is how we have to see mortgage backed securities has revolutionized the lending process, especially in the real estate or housing based loans process. Typically, as we have already discussed, as a part of MBS creation, we look at the first stage being the securitization. Today we see two major ways of securitization. One is government agencies does the securitization of the loans, and whichever the ones that cannot be securitized by the government agencies, they go through a private label transaction, and typically the process is called as a subordination mechanism. We'll discuss about this subordination mechanism, but the typical government agency route is evaluate each and every loan. Whatever the loans that are meeting the criteria could be with respect to credit quality, could be with respect to the loan amount, could be with respect to the credit history of the person. So whatever are the criteria that the government agency specifies, the moment those criteria all are met, the government agency pools all these loans by charging a small premium. It charges an insurance premium against all these loans, and what it does is, whatever the